Hello students, welcome back to my channel. So after having understood accounting, its functions and the various basic terms associated with the accounting, now we move on to accounting principles. Now we can say accounting principles are the basic norms or rules on the basis of which accounting transactions are recorded in the books of accounts. Now, why it is required? Because in order to understand accounting information in a better way, there should be uniformity. Without uniformity, you cannot compare your current year's performance with that of the last year or any of the previous year. So, here lies the importance of accounting principles. So, these should be understood and applied properly. Now, accounting principles can be categorized in two parts. First is concepts and second is conventions, and we will study one by one. Okay. Concepts. Concept means idea or notion. So in accounting, concept means the basic assumptions on the basis of which the financial statements of any business entity is prepared. Okay, these are the basic assumptions. Clear? And conventions, now here we can write basic idea or norms. Okay, and now we move on and conventions. Accounting conventions emerge out of the practices followed by the various organizations over a period of time. So these are the outcome of usage and practice. Okay, and these conventions may undergo a change in order to enhance the quality of the accounting information. Okay. So we can write convention means outcome of various accounting practices. Okay, clear? And let me tell you one thing. Even if these two are interchangeably used, there won't be any problem, because ultimately both mean the same thing, and this we will learn soon. Okay, now we move on to different accounting concepts and conventions. Okay, and we will take up one by one. So our first is going concern assumption. According to this assumption, it is assumed that our business entity will go on forever, and it is a going concern. That means we do not have any intention to close it down in the near future or any other time, or we also do not want to scale down our operations. The reason for this assumption is that we have to differentiate between our capital expenditure and revenue expenditure. Because for example, if we buy any asset for our business, we have to allocate its cost over the period of time for which it will be used. It is likely to be used. Take for example, we have bought a machinery for 1 lakh and we think that it will be used for 10 years. Then its original cost will be spread over a period of 10 years. Clear? And the depreciation will be charged accordingly. Okay. So going concern assumption says business will go for an indefinite period. Okay. We do not have any intention to close it down or to scale down the operational activity of the business. Clear? Having understood going concern assumption, now we move on to consistency assumption. According to this assumption, the business entity should go on with the same policies and procedures which it has been following over the years. But it doesn't mean that they cannot change the policies of recording. For example, there are so many methods of valuation of stock. Similarly, there are many methods of charging depreciation on fixed assets. But once adopted a policy, they should not change it unless and until it is imperative or they are forced by the circumstances to do it. Okay? So, we can sum up consistency assumption as the assumption which says there should not be deviation of policies of recording from on year to year basis. They should go ahead with the same policy. Uniform policy should be adopted. Okay? So, we can say no change in policy of recording. Okay? Now let us take up accrual assumption. According to this assumption, we should follow the mercantile system, which says the effects of transaction should be recorded when they are realized and not at the time when they are settled. For example, that means any credit transaction will be taken into account. It will be recorded. It will not be recorded at the time of settlement, or that is when it is dealt in cash or cash equivalent. Okay? So, revenue is recognized when sales is affected. Okay? Money is received or it will be received in a future date, it makes no difference. Since sales has taken place or the service has been rendered, you will record it in your business books. Clear? Similarly, when you have bought anything on credit, then you have to record it on the date of buying it, not at the time when you will settle it, when you will pay for it. Clear? So we sum up accrual assumption as the assumption in which events and transactions are recorded on mercantile basis. Mercantile basis. Okay? Clear? We have studied three basic fundamental concepts or assumptions of accounting. First was going concern assumption, second was consistency assumption, and third one is accrual assumption. Okay? Now we will move on to other important principles of accounting. Okay? Now we will study entity concept, or it is also known by the name business entity principle. According to this concept or principle, business and the owners of the business, they are distinct entities. They are two separate entities. They are not one and the same. So all the entries are recorded from the point of view of the business, not from the point of view of those who own it, those who own the business, that is the owners. Owners, according to this concept, owners are treated as the creditor of the business, and it is termed as internal liability of the business. Clear? And they are entitled to the extent of the capital invested. Clear? Simple. But this is the most important principle. Always remember, whenever we have to write any entry, whenever we have to record any transaction, it is always recorded from the point of view of the business and not from the point of view of the owners of the business. Okay? So, we sum up business and businessmen are separate entities. Okay, and we pass entries from the point of view of business. Okay, clear? Now we move on to money measure concept or principle. Money measurement concept, money measurement principle. It is one and the same thing. As the name suggests, we are going to record in the books of accounts only those transactions which are capable of getting converted into money. Okay? For example, you have bought chairs, furniture worth rupees 50,000. So you are going to record with the money value of the furniture, that is 50,000. Clear? And there may be times there are certain things which are very important and crucial for the business, but since those cannot be expressed in terms of money, will not be recorded. For example, the honesty of the employees. You have got very honest employees, very efficient and effective employees, but since these qualities, attributes cannot be measured in terms of money, so we are not going to record. Clear? So here we can say transactions capable of getting converted into money, it will be recorded. So money measure concept says only transactions which can be converted into money will be recorded. Okay? Clear? So according to this concept, in order to find out the financial position or financial income of any business enterprise, 1 year is taken as the base. Clear? So in order to find out our profit or loss for the period and the financial position as on date, we take a smaller unit, that is 1 year, and it has been accepted worldwide. Okay? So we can say one year period is taken as base to have performance appraisal of the business. Okay? Clear? Let me repeat. Since it has been assumed earlier the business will go on forever, it is a going concern. So it is not imperative, it is not wise to prepare your financial position or income after the end of the life of the business entity. So it has been accepted that 1 year period should be the base to find out your performance and your financial position as on date. Clear? Now we move on to full disclosure principle. Disclose means to open. According to this principle, the business entity, while presenting their financial statement, should disclose all the material information so that any user who can read, who can go through it, can be in a better position to take a decision regarding the affairs of the company. So all the important information should be disclosed. Clear? So we can sum up: all material information be disclosed. Okay, clear? Simple. All the material that is significant information should be disclosed. They should not hide any information that can help anyone to take a decision as to go for it or not to go for it. Clear? According to materiality concept, all the information which are relevant should be disclosed, and this concept is exception to the principle of full disclosure that we read just now. So, it is a subjective term. An information, an item may be material for someone and the same item may be immaterial for other person. So, important thing is the relevance of the information. If any information is relevant, it should be disclosed at any cost. It should not be hidden. Clear? For example, calculators are purchased and they are used over a period of time. But since the amount is petty, this kind of assets are written off. They are charged depreciation with 100% in the year of purchase. They are not carried forward. So, because cost of calculator is immaterial, it is treated as an expense and written off completely in the year of purchase. Clear? Sum up. Necessary information should be avoided. It is exception to full disclosure concept. Okay, we move on to prudence or conservatism principle. According to this principle, the business has to anticipate all the losses but not the profits. Profits will be taken into account only and only when these are received. These are materialized. But if there is a chance of getting a loss, we have to take into account that loss before it actually happens. Okay? Take for example, we value our stock, closing stock on market price or cost price, whichever is lower. The value which is lower will be recorded, though we have purchased the stock at a higher value. But since the market value is lower, then we will record with lower amount. So, we sum up. Anticipate losses but not profits. Okay? Clear? We move on to cost concept or historical cost principle. As the name suggests, the cost of any asset is recorded at the price which has been actually paid, not with the price with the prevailing one. For example, an asset has been purchased for 1 lakh, and while doing the final accounts, if the value has gone down or it has appreciated, we are not concerned with that. We will pass the entry with 1 lakh only. That is the cost at which we have bought, the amount that has been paid to acquire it. Clear? So, we will sum up as record assets at a price paid to acquire it. Okay? Since we are talking about the past cost That's why it is also known as historical cost principle. Clear? Now we move on to matching concept or matching principle. According to this principle or concept, the revenues of a period should be compared, should be matched with the expenses of that period in order to find out the real profit or loss, actual profit or loss for that period. Because in every business we want to know the actual position in terms of profitability and stability, and for that purpose this concept has been made. So if we are talking about a particular financial year and all the revenues earned during that financial period should be matched, should be compared with the expenses of that period incurred in that period, so that we can find out the actual position of profitability, whether we have under profit or we have under loss. Okay, so we can sum up: match revenues with expenses of the period in consideration. Okay, so that we can have a real position in front of us. Clear? Dual aspect concept or duality principle. Duality means double. Now this is the core of this principle, is the core of the double entry bookkeeping system. According to this principle or concept, every transaction has two aspects. One is the debit and other is the credit. And don't worry, very soon we are going to study in detail about this concept in the form of accounting equation, or to quote differently, as per the Newton law of motion, third law of motion, to every action there is equal and opposite reaction. Same thing applies here also. For every debit transaction there should be an equal and opposite credit transaction. Till for example, Ram started a business for rupees 2 lakhs. Now double, as per the dual aspect, there should be two aspects. One is cash, that is your assets, your means business. Second is the capital of the owner, it is a liability. So cash will be equal to capital. Okay, so we can sum up: it is core of double entry bookkeeping. Okay, clear? As per this concept of revenue recognition, the revenue is recognized to be realized when the transaction has been entered into and the obligation to receive the same has been established. Now let us understand with the help of example. For example, in December you have sold goods for 1 lakh and the concerned buyer promised you to pay in January. So revenue will be recognized in the month of December when the sales was affected. Okay, and not in January when the cash will be received. Clear? Now let us take another example. You are dealing in furniture and you have received an order for supply of furniture worth 1 lakh in the month of March, and you have received the order in the month of December, and you are given advance of 10,000. the revenue will be recognized in the month of March when the goods will be supplied, not in the month of current month, that is in January, when you have received an advance of 10,000. Till actual sales takes place, 10,000 will be your liability. Okay, so understood? Revenue will be recognized when an obligation to receive is established. In the previous example, you have you received an obligation in the month of December, and in my current example, you will get the obligation to receive only in the month of March. You have got advance. That is a different issue. Clear? So, according to revenue recognition, it will be when an obligation to receive is established. Revenue will be recognized when an obligation to receive is established. Okay? Cash is received or not, it is a different issue. Important thing is the obligation to receive. Clear? Now we take up the 11th, verifiable objective concept. According to this concept, all the transactions entered into should be free from personal bias. There should not be any sort of partiality. There should not be any such thing. So, and moreover, all the business transactions should be supported by certain evidence. These evidences may be in the form of cash memo, debit note, credit note, invoice, like that. Okay, so that the transaction can be verified. And the clear? So we can sum up. Verifiable objective concept says transactions should be supported by evidence. Clear? So with this we end up the chapter on accounting principles. Though I have summarized, I have tried to explain in the shortest possible manner. You have to go through your book also. You can revisit my videos for better understanding. Once again, let me tell you, if you have any sort of problem, you find anything difficult, you can ask me in comment box is there. Okay? So see you next video. Till then, enjoy good health, pay attention to your studies and make your future brighter. Okay? Thank you.